Welcome to the Financial Evangelist Podcast, your source for the latest in economics, crypto, and everything in between. From market movements to blockchain breakthroughs, we cut through the noise and bring you the facts, fast.
Hey everyone, and welcome back to the Financial Evangelist Podcast. I'm thrilled you're here to join me for another deep dive into the fascinating world of finance. If you're digging these deep dives, go ahead and hit that subscribe button. That way you won't miss any future episodes. Today we're going to try to unravel some fascinating and maybe even a little unsettling economic trends that are starting to make waves. So we've got a whole stack of sources here, and they all seem to be pointing in the same direction, towards a potential economic slowdown. It looks like this slowdown is probably going to hit us in early 2025. And from what we're seeing, two key areas are going to be right in the thick of it: consumer spending and the airline industry.
Yeah, it's really interesting how companies are reacting to all of this. I mean, remember a little while back, Delta Airlines CEO, he used that phrase, parade of horrible. He was trying to describe all of the challenges they were facing.
Oh, yeah, I remember that. It almost sounded like he was trying to downplay any serious economic concerns,
Right.
But then, when you actually dig into Delta's SEC filings, you see a completely different story. They're citing reduced consumer and corporate confidence as the main reason behind their less than sunny outlook. It seems like a little bit of a contradiction, don't you think?
It really does. And, this kind of highlights a disconnect we're seeing right now between disinflation and consumer sentiment.
Yeah.
So inflation has cooled down significantly since its peak back in 2022.
Yeah.
But consumers aren't exactly feeling the relief yet.
Well, why is that? I mean, you'd think that slowing inflation would be good news for everyone's wallets, right?
You would think so, wouldn't you? But here's the thing. While prices have started to stabilize, wages haven't really kept pace with those earlier price surges.
Wow.
So lots of households are still playing catch up.
Makes sense.
And it leaves them in a pretty precarious financial position.
So it's almost like they're running just to stay in place, even though it seems like the ground is moving slower.
That's a great way to put it, really. And we're seeing evidence of this financial strain playing out in consumer behavior. Walmart's CEO, Doug McMillon, he's observed what he calls stress behaviors.
Stress behaviors? What does that even look like?
Well, he's seeing shoppers switching to smaller pack sizes, and more concerning is that they're running out of money before the end of the month. And this aligns perfectly with the data that shows that income growth, especially for lower income households, is lagging behind those price increases we saw earlier.
So it sounds like even though inflation is technically slowing down, the damage is already done for a lot of families.
Unfortunately, yes.
Okay.
And this brings us to the airline industry. The airlines often act as a leading indicator of broader economic trends.
Right. The canary in the coal mine, as you always say.
That's exactly right. And right now, the canary isn't looking too good. We've seen a sharp drop in airfares. I mean, we're talking a 4% decrease in February alone. And slashed profit forecasts from some of those major airlines, Delta, American, Southwest. All of this signals that people are starting to pull back on discretionary spending.
Yeah, basically they're getting worried and cutting back on non-essential trips.
Exactly.
Makes sense, I guess. But how's the stock market reacting to all of this? Isn't the market usually pretty resilient?
Even the stock market, which tends to be a bit more optimistic, is showing signs of concern. So take the Dow Airlines Index, for example. It has plummeted a whopping 30% since its peak in January 2025.
30%. Wow, that definitely sounds like investors are starting to take this economic slowdown seriously.
It does, doesn't it? They're not brushing it off as a temporary blip anymore.
Okay.
It seems like they're starting to price in a potentially bigger downturn.
Hold on, I'm a little confused here. You're painting a pretty bleak picture, but didn't the February CPI report show the lowest core inflation rate in 4 years? Isn't that a good sign?
You're right. The CPI data did show some encouraging signs of slowing inflation. But we also need to consider other economic indicators, you see. Things like rising unemployment claims and slowing payroll growth. Those are flashing some warning signals.
So we've got these seemingly contradictory data points.
Mm-hmm.
How are we supposed to make sense of all of this?
Well, that's the million-dollar question, isn't it? We can't just look at one indicator in isolation.
Right.
We need to understand the bigger picture and how all these different pieces of the puzzle fit together. For example, slowing inflation is generally a good thing, but it can sometimes be a symptom of weakening demand. And that can actually lead to job losses and a much deeper economic contraction.
Okay, so things are a little more complicated than they might appear on the surface. And just to add another layer of complexity, let's talk about government spending.
Ah, yes, government spending. Despite all the talk about fiscal responsibility, the U.S. deficit has just ballooned to a staggering $1.1 trillion in just the first 5 months of 2025.
Wow, this.
We're talking record levels here, even surpassing the levels we saw during the 2008 financial crisis.
I thought they were trying to cut back on spending. What happened?
Well, the rhetoric and the reality don't always seem to align, do they? We're seeing a trend of government spending consistently outpacing tax revenues. And this has become particularly pronounced since the 2008 financial crisis, actually. It's a complex issue with no easy solutions.
So where does all of this leave us? What are the key takeaways from all of this information?
Well, the main takeaway is this. Consumer behavior, corporate performance, and macroeconomic trends, they're all interconnected in a delicate dance.
Yeah.
When one area slows down, it creates a ripple effect across the entire economy.
So it's all connected. Okay, that makes sense. And this brings us to the really big question. Given everything we've just talked about, is a full-blown recession inevitable? Or can the U.S. economy manage a soft landing?
That is the question on everyone's mind. And unfortunately, there's no easy answer. It all depends on a complex interplay of factors, things like consumer confidence, business investment, and of course, those government policies we were just discussing.
So more questions than answers, huh? Typical. But that's what makes these deep dives so interesting.
Right.
We'll be back with part 2, where we'll explore some additional insights and potential implications of this ever-evolving economic landscape. So stay tuned.
Sounds good. So, picking up where we left off, one thing that really jumps out at me is the vulnerability of certain sectors, especially those that are really reliant on discretionary spending.
You're talking about things like travel and entertainment, right? Those areas where people tend to cut back first when they start feeling the pinch.
Exactly. We already touched on airlines, but it's not just them. We're seeing similar trends in the retail industry. For example, companies like Foot Locker, they're already reporting weaker demand and having to slash prices just to try and entice those shoppers.
But earlier you mentioned that even those discounts aren't really working to get consumer spending again. It seems like they're really holding back. What do you think is driving that behavior?
It's a combination of factors, really. I mean, there's the obvious financial strain that's been caused by, years of high inflation and stagnant wages. But there's also this growing sense of uncertainty about the future that's weighing on people's minds.
Uncertainty about what, specifically?
Well, uncertainty about everything, really. The economic outlook, job security, global instability, you name it. When people feel uncertain, they tend to hold back on spending, especially on those big-ticket items, or things they don't absolutely need.
It's like that feeling you get when you're waiting in line for a roller coaster. You know it's going to be a wild ride, but you're not sure if you're going to love it or if you're going to end up feeling sick.
That's a perfect analogy. And remember, this uncertainty, it's not just impacting consumers, it's affecting businesses too. Companies are hesitant to invest and expand when they just don't know what the future holds.
So it becomes a self-fulfilling prophecy, right?
Yeah.
Consumers are hesitant to spend, businesses are hesitant to invest, and the whole economy just kind of sputters along.
Precisely. And this is where government policy comes into play. The government has the power to either exacerbate this negative cycle or take steps to actually try and mitigate it.
But their track record hasn't been great lately, especially when it comes to managing the deficit. We were just talking about how it just ballooned.
It's true. The government's track record on fiscal responsibility hasn't been stellar, particularly since the 2008 financial crisis. And remember the whole recent debate over the debt ceiling, that back and forth between Donald Trump and Thomas Massie?
Oh, yeah, that was a mess.
It was. It was a prime example of how political gridlock can make it really hard to actually implement any meaningful spending cuts. Massie took a hard line, against raising the debt ceiling, arguing that it was time to get serious about reducing spending.
And of course, Trump, he went on the attack, accusing Massie of just grandstanding and putting the entire Republican agenda at risk.
It was just a classic example of the political tug of war that always seems to happen when it comes to economic policy.
Yeah.
And unfortunately, it often leads to some really short-sighted decisions that prioritize, political expediency over long-term economic health.
So are you saying that the political system is actually part of the problem here?
It's certainly a contributing factor, I would say. The constant focus on those short-term gains and all the political maneuvering, well, it often prevents policymakers from implementing the long-term solutions that we need to address these really fundamental economic challenges.
Yeah, it's frustrating to watch. But surely there must be something they can do to try and steer the economy towards a softer landing. What about the Federal Reserve? Don't they have some tools they can use?
They do. The Fed can adjust interest rates, but, as we've seen in the past, those actions can have some unintended consequences.
Yeah.
And they often lag behind the economic cycle.
So it's like trying to steer a giant ship with a tiny little rudder. It just takes forever to turn things around.
Exactly. And we also have to remember that the Fed's primary mandate is to control inflation. It's not to prevent recessions. So while they might take steps to support the economy, their main focus will always be on keeping inflation in check. It's a delicate balancing act for sure.
Okay, so just to kind of recap for our listeners,
Yeah.
we've got consumers who are feeling financially stressed, uncertain about the future,
Right.
businesses that are hesitant to invest and expand,
Yes.
and a government that's grappling with a massive deficit and all that political gridlock.
And let's not forget about those conflicting economic data points we talked about earlier. We've got slowing inflation, which, on the surface seems like good news, but it could also be a sign of weakening demand. And then there's the rising unemployment claims and the slowing payroll growth, which are both kind of red flags for a potential recession.
It's a mixed bag, to say the least. Sounds like we're in for a bumpy ride no matter what happens.
That's probably a fair assessment.
Okay.
But even in uncertain times, there are things we can do to protect ourselves and maybe even find opportunities.
That's a perfect segue into part 3 of our deep dive, where we're going to discuss some practical strategies for navigating this unpredictable economic landscape. So stay tuned. Okay, so we've covered a lot of ground here, and I know this economic picture we've painted isn't exactly, well, the rosiest. But I think it's time to shift gears a bit and talk about what our listeners can actually do in this environment. What are some practical strategies they can use to weather the storm, so to speak?
You're absolutely right. Understanding the problem is only half the battle. The other half is taking action. So let's talk about some concrete steps that people can take to protect themselves financially in this climate of uncertainty.
Sounds good to me. Where do we even begin?
Well, first and foremost, I think it's really crucial to prioritize financial stability.
Okay.
And a big part of that is shoring up your emergency fund.
Right.
If you don't already have one, you should really aim to have at least 3 to 6 months worth of living expenses set aside, in an easily accessible account.
Yeah, that makes a lot of sense. Having that financial cushion can really make a difference if you encounter a job loss or unexpected expenses, especially during these uncertain times.
Absolutely. It's like having an insurance policy for your financial well-being.
I like that.
Next, I would suggest taking a really hard look at your debt, particularly high-interest debt like, credit cards. That kind of debt can really erode your financial security, especially in a period of economic uncertainty.
So tighten the belt and focus on paying down those balances as quickly as possible.
Exactly. It's all about gaining control of your finances and minimizing your vulnerability. Now, this next piece of advice might seem a little bit counterintuitive, but hear me out. Don't be afraid to invest, even in a slowing economy.
Wait, invest? I thought you were just telling me to, batten down the hatches and prepare for the worst.
Remember, the first step is always to ensure that you have that financial stability. Once you have that solid foundation in place, then you can start thinking about putting some of your money to work in the market. Counterintuitive as it might sound, down markets can actually create some excellent buying opportunities for long-term investors.
So it's about finding that balance then between, being cautious and seizing opportunities when they arise.
Precisely. And diversification is key here.
Okay.
You've probably heard the saying, don't put all your eggs in one basket. Well, it applies to investing too.
Right.
You want to spread your investments across different asset classes, sectors, even geographic regions. This helps to mitigate your risk.
Those are some really helpful tips. Okay, so we've got our emergency fund, debt management, and strategic investing. What else should our listeners keep in mind?
Perhaps the most important thing of all is to stay informed. Don't just bury your head in the sand and hope for the best. Keep up with economic news, read different perspectives, and be prepared to adjust your strategies as needed.
So basically, keep listening to podcasts like this one.
Exactly. But seriously, staying informed empowers you to make informed decisions about your personal finances, no matter what the economic landscape looks like.
Yeah, absolutely. This whole conversation reminds me of a quote I heard recently. He goes, it's not the strongest that survive, but the most adaptable.
That is a perfect way to sum it up. In times of economic uncertainty, the ability to adapt and adjust is crucial. It's how you weather any storm that comes your way.
Well, thank you so much for sharing your insights and practical advice.
Yeah.
This has been a truly eye-opening deep dive.
It's been my pleasure. Remember, knowledge is power, especially when it comes to your financial well-being.
And to all of our listeners out there, we hope that this deep dive has given you some valuable information and some food for thought. Remember, the future is always uncertain, but by staying informed and being proactive, you can navigate these challenges and come out stronger on the other side.
Well said.
Thanks for joining us on this deep dive into the world of finance. Don't forget to subscribe to the Financial Evangelist podcast for more insightful discussions on all things money. Until next time, stay informed, stay curious, and stay empowered.
Tired of spending countless hours sorting through your crypto transactions? Meet Coinly, your all-in-one crypto tax solution. Whether you're trading, staking, or mining, Coinly automatically imports and categorizes your transactions from over 700 exchanges and wallets. Generate accurate tax reports in minutes, track your portfolio performance, and stay compliant with your local tax authorities. Coinly supports tax regulations in more than 20 countries, making crypto tax season stress-free for investors worldwide. Join over 1 million users who trust Coinly with their crypto taxes. Visit the link in the description to get started today and receive 20% off your first tax report.